Hey everyone, welcome to today's Explainer. I'm so glad you're joining me because we've got some serious ground to cover. If you happen to glance at your portfolio on June 23, 2026, well, you probably did a massive double take, right? It was one of those days that grabs headlines, rattles nerves, and leaves us all wondering what on earth is going on beneath the surface of the global economy. But look, rather than just panicking over a sea of red numbers, our goal today is to really dissect these massive market movements. We're going to look directly at the underlying data from the day's trading. We'll connect the dots between shifting global policies, and we'll uncover some fascinating micro-shifts happening in very specific sectors. We are going to make sense of all this noise, together.
Okay, let's dive right into this. Here is our roadmap for today. First up, the market bleeds red. Second, we'll look at the tech slump and AI euphoria. Third, we'll zoom out to global pressures and policies. And finally, we'll end on the pharma silver lining. Let's get to it.
All right, part one. The market bleeds red.
To really wrap our heads around the gravity of this session, we literally just have to look at the opening drop. 900 points. That's how hard the Sensex crashed right out of the gate, sending an absolute shockwave through the financial ecosystem. And when a drop happens with that kind of velocity, the wealth destruction is just staggering. In one single wave of selling, a massive 6 lakh crore rupees in investor wealth was completely wiped out. Poof. This wasn't some gentle, routine correction, you guys. This was a visceral, high-stakes sell-off that had everyone, from big institutional traders to everyday retail investors, scrambling to figure out what caused this sudden vacuum in market confidence.
And if you want to see what a sea of red actually looks like, just look at these market stats from the National Stock Exchange. It's a striking imbalance. Declining stocks absolutely crushed the advancing ones. We're talking 2,280 stocks dropping, compared to a tiny 1,020 that somehow managed to scrape together a gain. Only 99 stayed unchanged. So this wasn't just a few bad apples. It was a broad-based, systemic retreat by investors across almost every sector.
Now, when a retreat is this broad, we have to look at the psychology driving it, right? Which brings us to a huge, headline-driven question. Is AI euphoria an overlooked risk for our markets? I mean, for months now, artificial intelligence has been pumping these absolutely unprecedented valuations into the market. But as the hype finally meets reality, are we starting to see this bubble leak? Well, to answer that, we've got to look at the exact sector that's been carrying the market on its shoulders.
Which brings us to part two, tech slump and AI euphoria.
The technology sector took a massive beating today, acting as a core driver for the broader market drag. But to really understand today's tech pain, you can't just look at today. You have to look at the longer trend. And the trend is brutal. The Nifty IT index has plummeted a staggering 28% over the past year. 28%! That means today's tech tumble isn't just a knee-jerk reaction to some overnight news. It's part of a prolonged, painful slump. Investors everywhere are constantly asking themselves right now, hey, do we buy the dip or stay extremely cautious? Because when an entire index loses more than a quarter of its value, it signals some deep structural headwinds facing these companies.
So, what exactly are those headwinds? Well, just look at the specific headlines hitting the wires today. We've got Tata Electronics dealing with the messy fallout of a cyberattack. We have Apple actively probing an alleged leak of internal files, all while trying to navigate limitations in an ongoing memory war. You see, these aren't just abstract valuation problems on a spreadsheet. These are literal operational crises. We're talking security breaches and supply chain battles. When the absolute giants of the industry are too busy putting out fires, the confidence of the entire sector naturally starts to waver.
But you know, the intersection of tech and finance isn't just restricted to the trading floor anymore. It's happening right in our pockets. We're seeing the rise of this wild new phenomenon, AI financial prompting. Basically, it's the practice of asking an AI chatbot for personal financial advice. People are increasingly asking AI where to invest, what to buy, how to save, but there is a massive, inherent risk here, and it completely boils down to what the user types into the prompt.
The absolute key takeaway from the experts is this. AI chatbots can certainly assist with financial advice, but they should never, ever replace professional guidance. Their effectiveness depends entirely on your prompts. Poor questions? They might just lead to completely inaccurate responses. It's that classic computer science rule, right? Garbage in, garbage out. If you don't know the exact financial parameters to ask the bot, the AI might very confidently hand you terrible advice. It's a stark warning for all of us to keep a really close eye on our wallets and maybe don't hand the keys over to an algorithm just yet.
Let's move on to part three, global pressures and policies.
Let's zoom out a bit from the Indian tech sector and see how this all builds into the much larger macroeconomic picture.
Because, as we know, markets do not exist in a vacuum. They are incredibly interconnected. First up, the U.S. Federal Reserve, now under Warsh, is turning out to be way more hawkish than a lot of currency managers expected. That means they're prioritizing higher interest rates to fight inflation. And a hawkish Fed usually means tighter money, which sucks capital away from riskier global assets. Second, the U.S. has issued a sanctions waiver on Iranian oil sales. Step 3, the inevitable result. Major ripples are bouncing across global energy markets, directly impacting import-heavy nations like India.
And of course, intertwined with these global energy shifts is international politics. Regarding the unfrozen Iranian funds tied to those waivers, former President Donald Trump commented that American farmers are satisfied regarding how and where that specific money will ultimately be utilized. It's actually a fascinating example of how complex diplomatic agreements can instantly ripple out, affecting domestic agricultural sectors and shifting global market sentiment in a heartbeat.
Speaking of global policy hitting home, check out this number, 1 lakh rupees. That's roughly $1,200. That is the new potential cost limit being floated for U.S. green card citizenship fees. For the thousands of aspirants trying to navigate the U.S. immigration system, a policy shift like this is a massive, immediate financial hurdle. It really goes to show how legislative changes halfway across the globe can literally hit the wallets of ambitious professionals right here at home.
And bringing those global financial rules even closer to home, the news today threw a spotlight on a very strict reality regarding overseas taxes. If you're earning and paying tax overseas, or honestly, even if you're just taking an expensive foreign holiday, you absolutely cannot afford to ignore your Indian tax obligations. The rules are super clear. You may still owe income tax in India, and if you skip your income tax return filing, that could trigger a highly stressful, unexpected income tax notice. Consider this your friendly reminder that global mobility requires meticulous local compliance.
All right, let's wrap up with part 4, the pharma silver lining. Now, after all this heavy, red-tinted news, there's a really important lesson in finance to remember. Capital rarely just vanishes. It usually just moves. On a day when the broader market crashed 900 points, we saw this fascinating divergence. A razor-sharp contrast emerged between the painful, heavy losses in the IT sector and the rallying resilience of the pharmaceutical sector. On an otherwise bleak day, pharma literally became the market's safe haven.
Now, what's really interesting about this slide is the stark mathematical reality of this sector rotation. Look at the IT giants on the top half. Infosys down 3.42%, TCS down 3.19%, Wipro dropping 3.21%. That is a ton of value completely erased in a single session. But look at the bottom half of the table. In those exact same market conditions, Cipla climbed 1.36%. Dr. Reddy's gained almost 0.8%. Sun Pharma finished in the green too. So while investors were bailing on tech due to those structural headwinds and valuation fears we talked about, they were aggressively parking their cash in the defensive reliability of healthcare.
And you know, that pharma resilience, it's backed by genuine fundamental global demand. A huge bright spot in today's news was the US FDA basically sending an SOS to Indian drug makers, asking for help to alleviate a critical shortage of a key cancer medicine in the United States. It just perfectly highlights India's indispensable role in the global pharmaceutical supply chain. And hey, even outside of healthcare, we saw some domestic industrial strength today. JSW is out there flexing its own proprietary tech for e-buses, as it fiercely competes for major government transit orders. So innovation and demand are definitely still alive. They're just maybe not where we've been used to looking for the past year.
Which leaves us with the ultimate question to ponder. With the undeniable tumbling of these tech darlings, hawkish central banks aggressively tightening up the global money supply, and massive geopolitical policies shifting the energy landscape, is what we saw today just a really painful market correction, or are we actually witnessing the turbulent start of an entirely new economic era? We are clearly looking at a market in profound transition. Keep your eyes on these numbers, stay focused on the fundamentals, and never stop questioning the trends. Thanks so much for joining me for this explainer, and I'll catch you next time as we continue to decode the data.